Welcome back to Curious Commerce. The topic Working Capital Management continuation from part 9. A business gets a big order, but money is needed immediately. Stock must be purchased, staff must be paid, delivery must happen on time. But cash will come only next month. So, what does the business do? It takes a short term loan. It's helpful? Yes. It's dangerous if you overused? Also, yes. Today, let us understand what are short term loans, how they help in seasonal needs, why they increase interest burden. The first question is what are short term loans? Short term loans are loans taken for a short duration, usually less than 1 year. They are used to manage temporary cash shortage, urgent business expenses, short term working capital gaps. These loans are provided by banks, non-banking financial corporation NBFCs, fintech app, and microfinance institutions. They are easy to take, but they must be used wisely. It is useful for seasonal needs. Many businesses are seasonal by nature. For example, garment shops during festivals, sweet shops during Diwali, hotels during tourist season, umbrella selling in rainy season, school supplies before academic year. During the peak seasons, demand is increased suddenly. Stock must be increased, extra staff needed, more working capital required. Businesses may take short-term loan to buy extra stock, manage higher expenses, handle temporary demand. This is smart usage of short-term loan because demand is temporary, income will come soon, loan can be repaid quickly, but short-term loans increases interest burden. Here is the danger. Short-term loans are generally easy to get. It is fast approval and very minimal documentation. But they are also high interest, strict repayment schedule, risky if income is delayed. If businesses starts using short-term loans regularly, interest costs keep increasing, profits start reducing, cash pressure becomes permanent, debt trap begins in the business. For example, loan taken for rupees 1 lakh, interest paid 20,000 rupees in few months. That 20,000 rupees is money lost from profit. So, rule is simple. Short-term loans should be solve temporary problems, not become permanent habit. So remember two powerful truths. Short-term loans help during seasonal or temporary needs, but they increase interest burden if overused. Smart businesses use short term loans like medicine, small dose when needed, not daily habits. Because working capital should support business, not slowly destroy it. Imagine the situation. A customer comes to you and discuss about your business and gives you money before you deliver the product or service. For this activity, loan is not necessary, right? Because already amount is paid. That's why the bank facility is not necessary, no internet necessity, and no repayment tension. This is not the charity, this is the smart business model. This is called advance from customers. Today, let us understand what it is, how it improves liquidity, why it is common in service businesses. Customer advances means customer pays the money first, business delivers product or service later. For example, coaching classes or education institution fees paid in advance, right? Hotel room advance booking, event management token advances, interior work advances, construction work advances, online subscriptions, software yearly plans, etc., etc., etc. Here, customer becomes the financier of your business. That is why this is concerned the business. That's why this is considered the best sources of working capital. It improves liquidity. It is the biggest advantage. Liquidity means availability of cash when needed. When customers pay in advance, businesses get cash immediately. No need to wait for income. No need for bank loan. No interest cost. This helps businesses to pay expenses smoothly, buy materials or the raw materials purchase, salary or wages to the staff, invest in the growth activity of the business. For example, a coaching institute collect rupees 50,000 fee from 100 students in advance. Total cash received is rupees 50 lakh. Now, institute can pay the money or the salary or wages to the staff and possible to get the better building for the rent and better for the marketing activity and better for the improved quality of the product or the service. All using customers' advance money only. This is powerful liquidity. It is common in service businesses. Customer advances are very common in service business or service sector. Why? Because service is delivered over time. No physical product immediately, right? But as trust relationship is built, advance confirms customer commitments. The common examples as follows: tuition classes, yoga centers, interior designers, construction companies, Maybe the construction company is related to the general business, it's not the service business. Sometimes the maintenances, AMCs, annual maintenance charges, freelancers, consultants, wedding planners. These businesses run largely on advance payment. In fact, many successful companies design their model so that customer pays first, business delivers later. So remember two powerful truths about advances from customers. Customer advances improve liquidity. They are very common in service-based business. Smart businesses don't run behind banks. They design systems where customers fund the working capital. This is the healthiest way to grow any business. For more simple and practical business concepts, subscribe to Curious Commerce, where commerce becomes clear and useful. Thank you all. For daily updates, follow WhatsApp channel Curious Commerce Financial Management Hub. Please like, share, and subscribe. The topic working capital management will be continued in part 11. Thank you all.